Despite my efforts to warn investors, I keep seeing comments and getting messages from people who are still buying stocks and funds I've been warning people not to buy for years. I've noticed that for a lot of people who are just starting out as dividend or income investors, they tend to gravitate towards these specific dividend holdings. But all of them either have terrible track records or a negative outlook. So in today's video, I thought it'd be a good idea to take a look at some of these popular high-yielding stocks that I would never recommend anyone hold in their portfolios. If you happen to be an investor in any of these stocks, the best advice I could give you would be to get out before you lose any more money on these. So with that being said, let's go ahead and get started. The first investment I still see plenty of people putting their money into is Orchid Island Capital, ticker symbol ORC. This ugly monstrosity is a specialty finance company that invests in residential mortgage-backed securities on a leveraged basis. Their RMBSs are backed by single-family residential mortgage loans, which are referred to as agency RMBSs. Their portfolio includes traditional pass-through agency RMBSs, such as mortgage pass-through certificates and collateralized loan obligations. They claim that their objective is to provide attractive risk-adjusted total returns over the long term through a combination of capital appreciation and the payment of regular monthly distributions. This company is structured as a mortgage REIT, and they were founded back in 2013. Just by taking a quick glance at this stock, we can see two things really stand out right away. It has a massive dividend yield of over 23% and it pays monthly dividends. For people who don't do enough research, they look at these two things and assume that Orchid Island must be a great investment. After all, if I invest $1,000 in their stock today, it would pay you $19.44 every month. That's a lot of monthly income from a pretty small investment. But we really need to do a little more research to get a better understanding of what we're putting our money into. Over on their balance sheet, you'll notice that their book value has collapsed over time. This basically represents the total value of an mREIT's portfolio, and an mREIT share price usually trades around their book value per share. Not surprisingly, as their book value per share has fallen, so has their stock share price. Since their IPO in 2013, ORC has fallen in share price by over 90%. They're actually brave enough to have an investment calculator on their website where you can calculate the total return of an investment in their stock over a period of time. A $10,000 investment on the day of their IPO would leave you with just $3,498. Even if you're tempted to think, I'm 80 years old, I want income now, and I don't care about leaving anything behind, you would still be experiencing a lot of dividend cuts. Back in February, I released a video titled, "Warning, these high-yielding dividend stocks will cut their dividends," and I included Orchid Island in that list. 2 weeks ago, the company announced that they would be slashing their monthly dividend from 16 cents to 12 cents per share, which is a 25% decrease. It was honestly an easy call though, considering that they have a history of reducing their dividends and again, the collapsing book value and share price. I also happen to notice that their stock has a very small insider ownership percentage. Insiders, which include the entire board of directors, only own 218,000 shares, which is about $1.3 million worth of their own stock. You would honestly think that a group of wealthy board members combined would own more than just $1.3 million of their own company, but apparently they don't even want to own their own company. That's a pretty good indicator to me that they aren't confident about Orchid Island's future, and therefore I don't think anyone else should be either. It's really incredible just how long this company has been able to hold on for. Almost since the day they were launched, they've been going downhill. Even when interest rates do get cut, I wouldn't recommend anyone try to catch the bottom because there's never been a bottom with this stock before. I know the high yield looks really enticing, but investing in ORC will almost certainly dissolve your wealth if they don't turn things around. The next stock I'm still seeing people invest in is Armour Residential REIT, ticker symbol ARR. This company has a lot of similarities to Orchid Island, yet they're apparently owned by different management companies. Armour Residential invests primarily in residential mortgage-backed securities issued or guaranteed by a U.S. government-sponsored entity such as Fannie Mae, Freddie Mac, or Ginnie Mae. Their agency securities consist primarily of fixed-rate loans. The remaining are either backed by hybrid adjustable rate or adjustable rate loans. Armour may also invest in interest-only securities, U.S. Treasury securities, and money market instruments. They were founded back in 2007. Just like Orchid Island, Armour Residential is also a mortgage REIT that invests in agency MBSs, and their stock also pays monthly dividends. Plus, both companies are also headquartered in Vero Beach, Florida, although in different parts. So I'm assuming they must have had some kind of connection to each other since they're both so similar, but again, this is another really popular dividend investment specifically for people looking for high income. You can see ARR comes with an incredible 35% dividend yield. That means a $1,000 investment in ARR would earn you $29 a month, again a huge amount of income from a small investment. And again, this stock also pays monthly dividends. If there's one thing I've noticed, it's that some terrible companies use monthly dividends as more like a gimmick to investors. There's a number of bad or just mediocre companies that pay monthly dividends as a way of enticing people. Companies like Orchid Island, Ellington Residential Mortgage, and Prospect Capital all pay monthly dividends as a way of trying to convince people to buy into their bad or lackluster stocks. Compared to Orchid Island though, Armour Residential is actually a much worse stock if you can believe it. They've had a dividend cut almost every year since they launched in 2007. Originally paying $16 per share at their IPO, today their stock now pays 40 cents a month. They've had 3 dividend cuts in the last 5 years, which actually isn't too bad considering their history. But you can see the destruction this 35% yielding stock has gone through. Whenever I research a new stock, one of the first things I do is look at their investor presentation on their website. This is like a brochure that nearly all large companies have on their websites. The investor relations department usually puts together this presentation once a quarter of a way of trying to introduce the company, highlighting all of their accomplishments, and reporting their latest financial results. It's basically like a brochure that's a way for the company to sell themselves to you as an investor. These things are usually around 20 to 40 pages long on average, and they're very well designed and have very insightful stuff, again trying to convince you to buy their stock. Armour Residential's investor presentation, however, is only 2 pages long and has very basic information on the company. So apparently even they don't have too many good reasons for you to invest in their own company. They don't have a calculator on their website, which is smart of them because their stock has lost over 96% of its value since their IPO. That's even worse than Orchid Island, and there hasn't been a profitable time to invest in Armour Residential for the majority of its existence. It was actually a little profitable between 2016 and 2020, but it's kept getting destroyed since then. In my opinion, both Armour Residential and Orchid Island Capital are the most popular high-yielding dividend stocks that I see new income investors make. If you happen to hold either of these two companies, please sell them immediately. These two charts should be convincing to you enough that a crazy rebound is extremely unlikely at any point. Please don't gamble your money with these companies unless they somehow get their act together someday. The next company is one that I know I'm going to get some criticism for, because I will admit that this one isn't nearly as bad as the others, but it's still been a pretty mediocre performer. Another really popular income investment would be Oxford Lane Capital Corporation, ticker symbol OXLC. This one isn't a stock, but rather it's a closed-end fund, but it's still a very popular dividend investment for its high yield. Oxford Lane primarily invests in securitized vehicles, which in turn invest in senior secured loans made to companies whose debt is rated below investment grade or is unrated. The fund seeks to maximize its portfolio risk-adjusted total return and is currently seeking to achieve its investment objective by investing in structured finance investments, specifically the equity and junior debt tranches of collateralized loan obligation vehicles. OXLC currently offers a yield that exceeds 20% and again pays monthly dividends. The track record of their dividend distributions is also pretty bad, but not as terrible as the others. Although they have increased it a few times, it's still significantly less compared to when they first launched in 2011. In 2016, they were paying 60 cents per share per quarter, where they now pay 8 cents per month. So it's dropped by almost 2/3 in the last 7 years. Looking at their share price, we can see OXLC has dropped by more than 77% since their launch. But although these things look pretty bad, I will mention that despite the terrible performance, if you reinvested your dividends, you would still be looking at a positive return if you had this thing since its IPO. Although past performance does not guarantee future performance, OXLC would have provided you with an average annual return of 5.39% after 12.76 years of ownership. It's obviously not a great investment, but anyone who bought this on the day it was first launched would still make a positive return. I've said this a few times, but this is what can happen with these extremely high-yielding investments. The dividends are so massive that a collapsing share price could still result in a gain. If you are wondering though, I ran these results with Orchid Island and Armour Residential as well using this calculator, and both were still very in the red. OXLC hasn't fallen quite as hard and their dividends have been a little more stable, but still it hasn't been a great investment. This closed-end fund holds 2 different types of investments, which are CLO equities and CLO debt. CLOs are securitized products which are created to acquire and manage a pool of leveraged loans. The loans inside of these CLOs are either typically rated very low or they're not rated at all. But because they're so diversified, it does at least add a little bit of safety. But the performance of CLO funds like Oxford Lane, Eagle Point, and others depends on how well the management team is at picking what goes into their fund, which in this case, OXLC does not have a good track record in. Ultimately, this investment isn't as bad, but I still don't recommend it to anyone despite its large yield. I would again encourage anyone holding these 3 investments to get rid of them, and I think there's other great opportunities out there right now. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.